This is Randy Finney with Right Side of the Chart, and this is an early session update for Tuesday, May 12th, 2020. Cut back on the updates lately because, again, sound like a broken record. There haven't been many new developments lately, and I'm going to talk about that. And we're actually going to loop back to just a few months ago when pretty much I was saying the same thing and watching the same type of development. So we'll look at that. Let's start out real quick with an overview of the broad markets. Let's see. Let's go to the longest term and then work our way down to the shorter term. I won't spend a lot of time because I just posted this chart recently. This is the monthly chart of the SPY. It shows your bull market uptrend line off the 2009 lows, breakdown back test, as well as that key 20-month exponential moving average and the big divergent high that was put in before that first leg down into the March lows. So that's it. It's again just a simple back test by just about every metric there, showing we could definitely take that level back. That's a possibility. I don't think it happens, but again, that is a very, very key level. Again, you can reference a chart that was posted recently, goes back for many years, showing you how it delineates or separates bull and bear markets right there. Bullish trend when the S&P is above it, bearish when it's below it, and you usually get these breakdowns that coincide with your bull market uptrend lines. That's your great bull back in the late 90s into the dot-com bubble. Broke the trend line, then broke the 20-month, stayed below it, acted as resistance, and regained it, and a new bull market started, and it told you that's what we were in. And again, so those are some of the levels we watch. And yeah, as I said, usually after the breakdown, there's always every bull and bear market has waves within it, and every bear market usually has an initial leg down followed by a kickback rally that retraces usually 50, 61, 61.8 is a key Fibonacci level. I think this one fell right between those two levels, the 50% and the 61.8, and look at that perfect weekly or monthly close right on the 20-month after a intra-month attempt to break above it. That's what that skinny part of the candle right here means. It means we rallied above it intra-month, but being that this is a trend indicator on a monthly chart, the only thing that matters is how you close that month, not what happens intra-month. Same thing on the 60-minute chart, where that 60-minute candle closes. That'll keep you away from the whipsaws. Whipsaws are when you break a support level or a resistance level intra-period, only to see the candle, whether it's a 60-minute or a daily candlestick, close at the end of the period back up on there. So that's it, bigger picture stuff. And again, I showed you that with the Dow. Let's jump down to the, let's go down all the way to the daily chart. And what's probably most important to me is the 200-day exponential moving average, or one of the most important things right now. And again, that's a very key level. Also does a good job of defining bull and bear markets, or more so, even within a bull market or a bear market, it helps define let's say, the intermediate term trend as well, not just the longest term trend. And one more consideration: when you have a lot of volatility or sharp moves leading up or down to a support or resistance level, you tend to get those brief, what I call momentum fueled overshoots. So what you had is you broke the 200 there, came back on 3 different attempts, tried to regain it, even popped a little bit above it, but failed. That's a rejection there, even though we popped intraday or one-day close above it. And then boom, violent rejection. So that's it. That's where we're at. We back tested that 200-day. Again, the red line here failed right there with a pretty impulsive pullback. We hit it yesterday, stalled there. We stopped today. Now we are there. We hit it once, and again, we can punch through it. And if we do, then a lot of traders watch this other line here, the 200-day simple moving average. I'll keep them both up on the screen because, again, some traders will trade off the simple, and they'd like to keep those on their charts. Some like the exponential. Therefore, I like to put them both up there for that one reason. All right. One more thing to look at on the daily would be your fibs. Fibonacci retracement levels, which I have somewhere here. There we go. This is the Fibonacci levels right here. Measure the move down off the highs. That high came on, I think it was February, let's tell you exactly when it was, February 19th. That's our high down to the low right there. And you can see that in addition to the 200-day so far capping all advances on this rally off the March lows, that 61.8 Fibonacci retracement also comes in perfectly with that 200-day. That's this dashed line right here. And so that's where we're at. And again, these are some of the metrics used to say counter trend rally back into resistance. Does the market feel bullish? Yeah. Does it feel like it wants to go to new highs? To some people. I mean, every time you get a rally, it's called recency bias. You think that will continue. And again, certainly something you can't rule out. But when do those odds, for new highs start to increase? Well, gradually, not all in one, in one fell swoop, but a solid break and sustained close. Especially a few days, not more than just a couple days like we had back here above that level. You take out the 200-day, you've taken out the 61.8 fib. Things like that would increase the odds that this the rally may have some more legs to it. And then jumping down to the 60-minute charts, as I said, we had this rising wedge right there with a breakdown divergent high, and the divergences continue to extend. So as I said for weeks now, really no new technical changes. The market's bouncing around. Even if it makes a slightly marginal new high, it'll be divergent high. You can see the divergence line would be extended. We've effectively, I don't know if I think we're a little shy. Yeah, we are a little shy of that previous high back here from late April. But for all intents and purposes, it's about an equal high. So we have divergence, and of course, any marginal new high. When I say marginal, it means a slight new high followed by a reversal. That'd be a marginal new high. This wouldn't be a marginal new high way up here, but this would. And again, that keeps the divergence intact. So when you take a look at this chart real quick, and what you see, the divergences have been building. You see a breakdown of a wedge, and then a smaller wedge set up with the divergences intact. All right, now let's go back in time. Let's do a little time warp here. I just told you February 19th was the all-time high. It'll mark a major milestone in the markets, or a major a key date, one of the biggest drops that we've had in the stock market in history over such a short period of time that followed that. So here's I figured I'll go back and let's see what we're saying on February 19th. The trend was strong. QQQ, the market was strong. In fact, it was an all-time high. Again, that was the all-time high. So like I said, nothing new. Near-term trend is bullish, keeps the existing uptrend intact. However, the negative divergences remain intact for now, so I'll be on the lookout for any decent signs of a reversal as well as confirmation of the divergences via bearish crossover on the PPO before it moves above the previous high, i.e. negating or taking out those divergences. That's what I just talked about when I said marginal new high. If you go up much more than that and you burn through the divergences, yeah, the technical picture changes. You take out the previous highs, you no longer have divergences. But up until that point, and again, this was marked, the highs end. Actually, that was the historic day right there, the end of the last great bull market. So that was on the 19th. And comments back then, there was only one. That kind of shows you get the someone calling for new highs. Hey, blow off top is coming. If the dollar drops or the Fed cuts rates, guess where it's going up? Well, guess what happened since then? Not only the Fed cut rates, they cut it twice, the biggest cuts they've had in decades, 2 back-to-back emergency rate cuts, and the dollar also fell, and it fell sharply. So we'll get to that chart in a second. So, and again, markets feel bullish when they're going up, and it seems like they'll never go down. But these divergences over time, they are not 100%. But they do play out much more often than not. The very next day, February 20th, same thing I've been saying lately, nothing new to report on QQQ as the negative divergences continue to extend following the yesterday's gap. Although any downside from here will confirm those divergences. That's one thing we look for. By confirming that, and we'll get to the today's charts. Go back in a second to today's charts, but this was the February 20th, the day after the market topped, and you can see I was looking for confirmation to confirm the divergences, because one thing about divergences is, and again, this is just in my terms, I don't think it's I've never seen this in the textbooks, but I consider divergences only to be potential when you're making a series of lower lows on the indicators and higher high on prices as long as the indicator is moving up, because it could continue to go up. So it's once you get that lower peak, and so I use the bearish crossover because that effectively puts in a lower low or lower peak in the indicators, and that confirms it. So that was some near-term targets. Again, market was at all-time highs, but it was pretty clear where, like I said, the risk reward, the charts were indicated despite the current trend, it was most likely heading lower. And again, and I want you to look at this too, and this is something very, very similar to what we have today. See, we had a rising wedge pattern with a breakdown. And sometimes you break down and that's it. You never look back. Sometimes you break down and you continue to rally. In other words, it appears to be a failed breakdown or a false sell signal, whatever you want to call it, because the market takes a new high, in which case QQQ did. But again, nothing changed in the technical posture. Those divergences remained intact. Here's another example of why sometimes, and why I will say, and probably did back then, that was a sell signal, because sometimes you break down and that's it, and then boom, there's the big move. You don't get a kickback rally, you don't back test, you don't make a marginal new high. They're all different. That was divergence there as well. This is again an old chart. I'm just laying over back from the 20th of February. And then one more. Well, let's look here. Same thing on SPY. SPY had a nearly identical technical posture to QQQ, with the current divergences to be confirmed via bearish crossover, which was about there. And again, that was the day after the markets topped. And these charts look identical again to right now. You had the wedge, you had a trend line off the lows on the 60-minute chart, a little wedge pattern there. Breakdown, back test, but we kind of moved sideways. We didn't really correct so much in price, more in time, and then we went on to take out that previous high. But again, nothing changed technically, and again, history was, we know what happened from there. That was again the end of the last bear market or bull market, and then finally the next day, the 21st, 2 days after the top was in. Go all the way back up here, charts I'm watching, and I had some key levels that need to be taken out, and that holds true now. I've highlighted some key levels on all the sectors in the S&P 500 and the markets, and some of those levels, I think I had those marked in blue recently. Some were taken out, but a lot weren't. So we still don't have those key support levels that need to be taken out to open the door to a much bigger sell-off. But again, that's how it did. We did, of course, take those out back then, and the rest was history. All right, so there was yes, showing us going down, and then back to that. I said there was a comment on the dollar on all those charts back then. Remember, the euro is often, I'll use it as a proxy for trading the dollar or trying to figure where the dollar's going, because it's the biggest component of the dollar index. It's 57.6% weighting, I believe, something like that. And therefore, when the euro goes up, the dollar goes down, and vice versa, because that's how the dollar index works. All right, so back then, the euro was clearly in a bullish setup, which means the dollar was clearly in a bearish setup. And the euro appeared poised for a substantial short covering rally and offered an objective long entry, and that was again on the 20th. And so the point is to that other comment, hey Randy, if the dollar goes down, the market's going to rally if the Fed cuts, and they did both those things, and the opposite happened. So back then, where was it? This was it right here. This is a chart of the E7 Euro futures. And that was like February, right around here, weren't we, about the 20th or so. And so that was the biggest move the euro had in many, many years, maybe even decades. And again, it was indicated by the charts that said the euro would go up, dollar would drop, and it did. Eventually it corrected after a heck of a run, and then the dollar rallied after that. But the dollar, remember, was the euro climb there. The dollar spiked, dropped, plunged, as did the stock market. Okay, so that was then, this is now, and again, just like back then, we had nearly identical technical postures. We had a rising wedge on the 60-minute chart which broke down but didn't really play out right away, kind of moved sideways. Again, SPY hasn't made a new high, almost an equal high there, and you can see whether it turns down now or whether it can punch on through there. It would be, pretty much the identical posture. The breakdown of the larger wedge with a little smaller wedge setup, and the divergence is still intact, and would be as long as we don't go much higher there. And if we go much higher, then yes, the technical posture has changed. We don't have these 60-minute divergences. We'll turn our focus again to the daily charts and weekly and monthly charts. And there's still plenty of overhead levels. We can pop the 200-day. Wouldn't surprise me one bit. In fact, I'll tell you, to be honest with you, going back to that 200-day moving average, the red line, I'd say the highest odds are that it gets popped. Usually when you come up to test it, let me turn off all these, you go on through there. Usually when you test it from above, you go on down through there. And I don't know if it's the fact that these are the algos, the money maker, market makers, powers that be that burn stops, but you can see in almost every instance you tested it, at least intraday. Again, you look at the skinny part, those are your intraday moves, and the candlestick, the fat part, the body will show the open and close. So in almost every instance, for all intents and purposes, those are tests. That's a successful test, but you did pierce it briefly, at least on an intraday, and sometimes even on a daily closing basis, and then failed. So here it is. We've hit it there, we hit it here, we hit it again today. Wouldn't surprise me to see it pop, but it's resistance. So am I going to try to game it or go long to hold what could be a 1% intraday or a 2% daily move above it? No, it's TA 101. TA 101 says you short a rally back into resistance, or if you're a bull and you think it's going higher because you're bullish on that security, you wait for a breakout, a solid breakout above, and then you can put a stop below. But right now, for all the reasons I discussed, this is likely to come in as resistance. It's not just the 200-day moving average. Like I said, there's price resistance there. There's key Fibonacci retracement levels there at the same level, and most importantly, we have divergences across the board. And it's not just SPY. I was showing you QQQ when the market topped. Qs have been stronger, but remember, QQQ is not really it is an index technically, but it's more so a concentrated index with 5 of the largest companies, the $1 trillion or close to $1 trillion companies, the ones I call the FANGs, FAAMG. They are the primary drivers of it. In addition, it's 50% tech, so it's not, again, it's an index. It's great to trade, but it is very far from representative of the entire U.S. economy. You're not seeing massive layoffs in the tech sector. Because when you look at the S&P 500, you have industrials, you have REITs, you have restaurants, and banks, financials, things that some of those things, especially the financials, are lacking in the Nasdaq 100 here. And so again, just like back then, this was the chart back from literally the day the market topped, and you can see there that's what it looked like. It felt bullish. Obviously, there weren't a lot of comments that day. But the one comment said, yeah, the market's going to have a blow off top. This is, whatever. And, hey, that was a possibility back then, I have to say. If we would have burned through here, because as I often say, fewer things in trading and investing are more bullish than either a failed bearish breakdown, bearish chart pattern breakdown that fails, or maybe a well-watched, bearish technical development that fails to materialize. In other words, never really plays out and gives you that sell signal. That's not what happened. This is what happened back then, and today we'll see if it's going to be any different. But right now, the technical posture is nearly identical as it was back then, and that's what trading's all about. There's no certainties. I don't pretend to have all the answers and tell you with absolute certainty where the market's going to go. I'll tell you my convictions. You'll get that from my voice and my words directly, how strong I feel in something. At this point in time, I think the fact that Again, the Qs it's a whole different story, but in the S&P 500, still far from highs. But the fact that the Qs are even anywhere close to all-time highs to me is baffling, and I think there's going to be a rude awakening. I talked about that. I think some others on the site mentioned it too, that the earnings season we just got through only caught the tail end of COVID. I think the true impact, these things take months to really be reflected in earnings and a stock price. I think a lot of that's going to be reflected in next quarter earnings. And the thing about the market, it always looks out ahead. This whole rally that we've had, it was telegraphed well in advance, for weeks. At least a couple weeks there, highlighting the divergences and saying the risk reward was no longer attractive to shorting. There would be no more shorts on the site, only longs. And that was, again, just like back then. There's that small wedge back there that happened to be marked the top in the market. That's that same little wedge right there. Breakdown, kickback rally, and that was a move down. And again, wash, rinse, repeat. Negative divergence. And then we came full circle after the correction, or during the correction towards the bottom. We started building these bullish positive divergences, which was the technical catalyst for this. Again, the markets don't fall forever, they don't rise forever. Even if they're going to go to a point from point A to point B, from here to here, they don't go like that. And I'm talking the primary trend. There's waves within those trends. And towards the end of each wave, the masses, after, if you're in, let's say, in a bear market, everyone's getting bearish here, wants to short. They don't want to short here, top of a bull market. They don't want to go long right here, but they want to go long right here, in the second half or higher of that, the second half of the first rally. And, then they'll start buying the dips on the way down. Once you combat those lows, that's where they start to capitulate and don't want anything to do with stocks again until the next bear market rally, usually at the top. But if we get another big drop and we come anywhere near those old lows, I think we'll take them out. And that's usually when you get, then the Elliott waivers. That's where they'll talk about the wave counts of a primary wave in a primary trend or primary wave count, with being a 5-wave cycle. With this being wave 1 down, P2, the primary second wave up, counter trend rally, and then P3 is always, or usually I should say, in a 5-wave count, it's always the most powerful. And that was the same thing that we had in the last bear market too. If you remember back then, this one here, same thing. You had your first correction, or in hindsight, of course, we can look back now and say first leg down in the bear, followed by a counter trend rally that came right back to the 200-day moving average there, and between the 50 and 61% fib. Everybody, figured, okay, the worst is over. It was just a correction, time to buy, and then came P3, the big wave down, followed by fourth wave up, and final fifth wave before the bear market was over. So that's it. Nothing more really to talk on the Qs, other than here's our smaller. We broke the wedge before, and you have the smaller trend line. I think I had on this board here. Yeah, there it is. Those are those purple levels I said need to go. There's at 211.33. We still haven't taken that out, so you can see here we are wedging up, divergent high 1, little correction, divergent high 2, little correction, divergent high 3, all along as the divergences continue to build and grow larger. And potentially setting the stage for a much larger drop. We'll see. First things first, we need some sell signals. We've gotten little sell signals. We've had sell signals recently, but they played out for corrections, but not very big. And again, they're hitting some support levels that are holding. Oh, one thing I want to show you, and then we'll wrap it up. And we're just sticking to the indexes here. Is IWM. I haven't talked about it lately, but it's worth watching. Here's IWM on a 60-minute chart. Kind of busy chart, a lot of lines here. These were really last time I was interested back here, and we put in that divergent low. We had bullish divergences on IWM, just like the market back here. Just like S&P 500 and the NASDAQ 100, that is. And, had these upside targets, all of which were hit, T1, T2, T3. And that T3 held for a while. We grinded around and had another thrust up. So what we've done since then, again, I haven't updated this one in a little while, so I just wanted to share it for you small cap traders. We have this trend line to watch now, and it's pretty fairly well defined at this point. And you had divergence right here, like SPY and QQQ, and that divergence has been building, negative divergence. Now, it's almost coin toss odds to me whether we're going to have another thrust up, a little more upside in the small caps, and even in the broad market. Maybe the SPY wants to take a run through that 200-day exponential moving average, maybe pop above it for a little bit, maybe even run up to the 200-day simple, which is a little bit above that. But what we're looking at here is, if that happens, again, nothing will change, at least not from the technical posture, at least not from these divergences here on IWM. And there's a big old gap. In fact, let me show that to you on the daily chart. Here's IWM on the daily chart. Let's see, here we go. This is a good board right here to look at. All right, so you're looking at IWM, which has been in, make no mistake about it, small caps have been in a bear market since 2018 right here. They peaked a long time before the large caps did. That was their top, and we've been, moving lower since. From that high, that all-time high from the end of the last bull market in the small caps back in 2018, these are the Fibonacci lines. So I measured from that high down to the lows right here, and you can see the fib levels here. So as strong as this run lately has been in the small caps, they've only retraced 50%. That's a key Fibonacci retracement level, 50% or half of the drop off the top of the last bull market. In other words, their bear market rally right now is run back to the 50% fib. Could it go higher? Absolutely. In fact, you can see here you have a big old gap. Now, technically, the gap is, we closed there, right there at the bottom of that red candle, but I see big resistance here. I see a lot of levels. I'm marking those, a lot of reactions, I should say, along this level here, about 143.84. So including that level, then we had a little red candle and then gap down. But so this is the gap I'm using right here. And again, technically, top of the gap is a little shy of that level. You may want to make note too if we run up there, because traders will be focusing on the the actual top of the gap there. So what happens? Well, we've already run up. Well, that defined the gap right there, and we already tested the gap once, the bottom of the gap, and had a violent rejection, failure there. And we have this uptrend line, so we're walking above this uptrend line, and the bullish, near-term bullish scenario would have IWM holding this trend line, coming back, making another test to the bottom of the gap, then entering the gap. Gaps, once entered from below, are usually backfilled, not always, but often. And so that would be near-term bullish scenario. And what you have a mountain of resistance if that gap is backfilled. You have the key 61.8 Fibonacci retracement. You can't see it because it overlaps almost perfectly with that 143.84 support, former support, now resistance level that I have right there. So you have price resistance, key Fibonacci resistance, and the key 200-day moving average exponential right there as well, all coming in together. And if it can pop, depending if and when it gets there. Remember, moving averages, just as the name implies, they move over time. They're going to change. So, if we kind of grind it around here, the one thing about this being a bear market rally, which I still believe it is in time, I looked at the previous bear markets, those rallies lasted much longer. So, I can easily see some more grinding around. And I know as frustrating as it is, I have to imagine there's a lot of people frustrated, both bears and bulls, longs, those long and short, or any positioning. Because again, the market's chopped around. The big move was off the bottom in the last few months, especially in the broad market, the S&P 500. We've gone virtually nowhere now for almost a month. We've traded sideways. And we could do that for a while longer. And it could be a relatively tight range. It could be a big range. I don't know, but what I'm looking for are some decent sell signals, such as breaks of these trend lines, rejections off these levels, and again, can't rule out that, especially if this gap is entered, that we run up there. And if we did, what I was getting at is maybe that 200-day will come down a little, the simple, or if we continue to rise here, actually, I take that back. Well, I don't take that back. That is a possibility, but the 200-day exponentials move faster. They react a little faster to prices, which is one reason I like to use them. In other words, what I'm talking about, you can see here that the 200-day exponential turned down faster once the top was in the market. the slope went negative, and that's one way to look at the trend as well. When you have a positive slope, for those of you who remember math back in high school, this is a no slope if a line's a flat line. This is a positive slope. Any line that angles up is positive, and anything down below is a negative slope. So right here you had a positive slope. The trend was bullish on the 200, and it inflected about right here, turned down lower, and it's been lower. It's starting to flatten out, but it hasn't turned up yet. So this trend indicator as well, among many, is saying small caps are still in a bear market. And now if it turns up, or at least flattens out, and that's what it would do if we rallied up here, the small caps, the 200 would flatten out at this point because it's heading down. It would start to, on its way to turn up along with prices, it would at least flatten out here for a while. So I want to just say that would be almost a perfect confluence of three very significant, well-watched levels. Some traders only use price levels, so they'd be watching that 143.84. Some only use moving averages. Some only use fibs. I like to incorporate them all. And again, because the more subset eyes are watching those various levels, the more likely you are to see sellers step in, longs take profits, and shorts step in. Now, we don't have to get there, but I just want to say it's certainly a possibility. And until we get some hard sell signals on the market or evidence of a reversal, like I said, it's hard for me to sign anything much better than coin toss odds on it. How much would it be from where we're at? About 9% or so if we were to rally up there in the small caps. But and I can't impress this enough. I just talked for a few minutes about that being a big level if and when we get there. Which, by the way, for those think the market's going to new highs, the bear market and small caps are over. Yeah, if you take all those levels out, clearly take them out. Yes, that's very bullish to take out a confluence of resistance like that. So there's something for something to watch if and when we get there. And I can tell you that I'll have to certainly respect that breakout and maybe get in and trade it. Go long with stops somewhat below those three resistance levels, which would then be support once they're broken. All right, and then finally, just to get back to where I was at, until and unless that happens, like I like to say, resistance is resistance, and we have the gap plus Fibonacci resistance and several rejections there so far, and then of course you have the trend line support as well. So bearish would be a break of the trend line. Bearish would be another failure at the 136-ish level. All those things there. Okay, I want to wrap up here, and I didn't want to get off on a tangent because this is a different instrument completely, LQD, but I just wanted to update it and save having to put a post out there. I told you for a while I haven't been excited about this trade since the Fed came in to backstop the bond markets. But I did tell you I was expecting a gap backfill, and that's what we got. That means they backfill this huge gap right here. That was news induced when the Fed came in and said they invoked emergency charter powers to come in and be able to actually intervene and directly buy low grade and below investment grade bonds, junk bonds, investment grade bonds as well. Even ETFs such as LQD, they have the ability to buy that now, where normally that's outside the scope of their power. And so that was that, a lot of that, as I pegged it at the time, to be a lot of short covering, and so we pulled the stop that day and then reinstated it, and it stayed below it. But what I wanted to say is I expected the gap backfill. That may be all we get for the time being, at least. I think we could probably work our way lower over time. I do believe that. And I think, in fact, as the higher the market goes, the stock market, if it happens to go higher, I think we'll probably see LQD drift lower. You might say, well, that doesn't make any sense. That would show, better economic growth expectations. Well, what you'll see is the Fed, they bit off, I think, a lot more than they could chew, and I think they know it, and they will start. As a fact, I think most of the Fed governors are talking today. There's a handful on the economic calendar today and tomorrow. Bullard, I think Powell's tomorrow maybe. So there's going to be a lot of the Fed, those on the Fed talking, and what I think they're going to do is throttle back on their support the markets, because they went all in, bringing out the bazookas and the tanks and everything they could have done. And so I think they will, try to unwind as much as possible. When they see stability in the financial markets like we've seen lately, that's their cue, their chance to exit. And if they don't exit now or soon, at least somewhat. So where I'm going with that is, yeah, I think we'll work our way down there eventually. But right now we hit the gap backfill right there. We're bouncing today. And what I'm going to do is wait for the next reaction high. Don't know how far this bounce is going to go, whether we come all the way back up to the top of the gap there, about 128.90, or fall shy. I think that's about the maximum. And at that point, I'm going to lower the stop either just above that 128.90, or if we get a reaction high below there, I may even lower the stop a little more aggressively. In other words, we go like this and then reverse. Once I see that, I may lower that stop there. I just kind of want to let you know my thought process on that trade. And then I already shared my thoughts on the equity market, so we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.